Silver could be days away from a move that changes everything for the rest of this year. Most of you think this is just another weekly outlook video. Stay with me because what is scheduled to drop this week is not routine, and if you understand what it could trigger, you will see why traders are positioning right now, not after the headlines hit. I am going to show you three things in this video. I am going to show you why this week's data releases carry more weight than almost any other week in the last 6 months. I am going to show you what the gold-silver ratio is quietly telling us right now while everyone is distracted by headlines. And I am going to show you two completely different price paths for silver depending on how this week unfolds, both backed by real numbers, not guesses. Before we get into any of that, let me be clear about what kind of video this is. Everything I show you here comes from COMEX and CME Group positioning data, from Silver Institute supply and demand figures, and from published research out of Bank of America and Goldman Sachs. This is not a hot take. This is a read of the actual mechanics underneath the price, and once you see them, you will understand why this particular week matters more than most. Let's build this from the ground up. Silver right now is sitting near $29.40 an ounce, holding just below a multi-year resistance zone it has tested and failed to clear twice already this year. That alone would be interesting on a normal week, but this is not a normal week because we have a cluster of macro data releases landing within days of each other, including fresh inflation readings out of the United States, a Federal Reserve commentary window, and updated industrial demand figures tied to solar panel manufacturing in China. Here is why that cluster matters and why you cannot look at any one of these releases in isolation. Silver is unlike gold in one critical way. Gold trades almost entirely on monetary expectations, on real interest rates, and on currency debasement fears. Silver trades on both of those things and on industrial demand at the same time, because roughly half of all silver demand now comes from industrial applications, with solar photovoltaic manufacturing alone consuming a record amount of physical silver last year according to Silver Institute figures. That means silver this week is exposed on two fronts simultaneously. If inflation data comes in hot and the Fed commentary leans toward holding rates higher for longer, that normally pressures precious metals through the real rate channel. But if Chinese solar installation data beats expectations in the same window, you get a competing force pulling silver upward through the industrial channel at the exact same time the monetary channel is pulling it down. This is the kind of collision that produces violent, outsized moves, not quiet drift. Now stay with me because this is where the gold-silver ratio becomes critical and you cannot understand what comes next without it. The gold-silver ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, when this ratio gets stretched to extreme levels, it has signaled that silver is undervalued relative to gold and primed for a sharp catch-up move. Right now, the ratio is sitting in a zone that has, on two separate occasions in the last 15 years, preceded silver rallies that outpaced gold by a wide margin within a matter of months. The first time was in the aftermath of the 2008 financial crisis, when silver eventually surged from under $9 to over $48 over the following years. The second precedent came during the 2020 pandemic recovery, when silver moved from the low $12 range to nearly $30 in less than a year as the ratio compressed sharply. I am not saying this week reproduces either of those moves. I am saying the structural setup, a stretched ratio combined with a converging data calendar, has historically been the kind of environment where silver stops drifting and starts trending hard in one direction. Now here is the part that should make you sit up. COMEX data released through CME Group has shown a steady build in open interest on the long side over the past several weeks, even as price has stalled beneath resistance. That is not a neutral signal. That is large positioning building quietly underneath a market that looks, on the surface, like it is going nowhere when positioning. Builds like this beneath a flat price, it tends to resolve in a breakout, not a breakdown, because the capital underneath the surface is not parking there for no reason. Before we move to where this could go, I need to ask you something directly, because this is the part most viewers skip past without thinking about. Are you the kind of person who watches setups like this unfold in the data weeks before the headlines catch up and actually positions yourself accordingly? Or are you the kind of person who waits until silver is already trading 15% higher, already on every financial news channel, already being talked about by people who had no idea this week's data even existed, and only then decides it is time to pay attention? Because that second group always pays a higher price for the exact same metal. They buy the move after it already happened instead of understanding why it happened. The traders who do well in this market are not smarter than you. They are simply paying attention to the mechanics before the crowd does, and right now this week, the mechanics are flashing. So let's talk about where this actually goes, because there are two real paths here, and I want you to understand the full chain of events behind each one, not just a number in the bull path. Inflation data comes in at or below expectations, Federal Reserve commentary leans toward eventual rate cuts later this year, and Chinese solar demand figures confirm continued record installation rates. If all three line up, the real rate pressure on silver eases at the same moment industrial demand confirmation hits. That combination is exactly the kind of dual tailwind that has triggered sharp short covering rallies in COMEX futures before. In that scenario, silver could push through the $30 resistance zone within days and potentially test the $32 to $33 region within the following few weeks as momentum traders and short covering accelerate the move once that resistance breaks. Now the bear path, if inflation data surprises to the upside and Fed commentary leans firmly toward holding rates higher for an extended period, the real rate channel tightens hard, and if that lands at the same time solar demand data disappoints even slightly, you remove both legs supporting silver at once. In that scenario, silver could break down through the $28 level and potentially retest the $26 to $27 range, as leveraged long positioning we just talked about gets forced to unwind, turning that quiet build-in open interest into the very fuel that accelerates the drop. Both of these paths are sitting on the table right now, loaded by the same data releases, decided by outcomes we do not yet know. That is not me being indecisive. That is the honest structure of a market sitting at a coiled high-tension point, and anyone telling you with total certainty which way this breaks before the data even prints is not reading the market, they are guessing. What I can tell you is that the setup itself, a stretched gold-silver ratio, a quiet build in COMEX positioning, and a converging data calendar has historically not stayed quiet for long. So here's the question I will leave you with. When this week's data lands and one of these two paths starts to confirm itself in real time, will you already understand why it is happening, or will you be finding out for the first time from someone else's video after the move has already started?